Okay, let's dive in. This is the deep dive where we take your sources, the articles, the research, your notes, and really pull out the most important nuggets of knowledge and insight.
That's the plan.
Today, we're pulling back the curtain on the often, intimidating world of hedge funds. We're using insights drawn directly from Sebastian Mallaby's deep dive into the topic.
Right. It's a really compelling look, this book. It gets into the key players, the strategies, and importantly, the very real impact these firms have had on global finance.
So our mission here in this deep dive,
Is basically to navigate this pretty complex history, pull out the crucial details, and give you a clear understanding of how this corner of finance came to be.
and its role in some huge financial moments over the last century or so.
Exactly.
So let's unpack this, starting right at the beginning. You hear hedge fund today, maybe you think massive glass towers, right?
Yeah, Wall Street skyscrapers.
But the origin story, according to the source, it's quite different. The very first hedge fund was created by a fellow named A.W. Jones, late 1940s.
And his background.
Yeah.
It's not what you'd expect. Not finance at all.
No. Super varied interests. Politics, gardening, connections to the German left, maybe even some intelligence work back in the 30s and 40s.
The source mentions that, yeah.
Yeah.
And he apparently hitchhiked to the Spanish Civil War front lines for his honeymoon. Ran into Hemingway. Quite the life.
Definitely. But by his late 40s, family, expensive New York tastes, as the source puts it.
He needed to make some money.
Right. So he rounds up $60,000 from friends, puts in $40,000 of his own, $100,000 total, and gets into investing.
And what made his venture revolutionary wasn't just what he invested in, but how. He pioneered this concept of the hedged fund,
Using both long positions
buying stocks he thought would go up.
and short positions, betting on stocks he thought would fall.
Right. And the goal wasn't just making money if the market went up or if specific stocks fell. The real innovation was trying to profit purely from his skill at picking winners and losers.
While neutralizing or hedging the overall market risk, is that it?
That's exactly it, trying to isolate that stock-picking ability.
The source gives an example, doesn't it? How he calculated it.
Yeah, it's pretty neat. He'd measure his long stocks against the market average and his short stocks against their market average.
Yeah.
The difference between those performances, after you account for the market's overall direction, that was supposedly down to his skill.
So if his longs beat the market and his shorts did worse than their market,
Meaning they fell more, relatively.
then that's profit purely from selection. Doesn't matter if the whole market was up or down.
Precisely. Independent of the market tide.
And he innovated in the business structure too, right? Leverage.
Oh, yeah. The source notes he used leverage borrowing to amplify returns and losses, of course, and he developed that profit-sharing model for managers.
The performance fee. And wasn't there a tax angle?
Uh-huh. Thanks to his lawyer, Richard Valentine, they found a way to get it taxed at the lower capital gains rate. A nice loophole.
Plus, he was super secretive about his methods.
Extremely. Probably honed that skill during those
Oh.
earlier activities in Europe you mentioned.
That secrecy must have helped him keep an edge for a while.
It definitely did. But, like any good idea, eventually people figured it out. It got copied.
So by the late 60s,
The source says there were hundreds of imitators. Many had worked for Jones or were his brokers. And the term hedge fund, a simpler version of his hedge fund, that entered the Wall Street vocabulary formally.
okay, so you get this explosion of funds, and then they hit a wall.
Exactly. Late 68 to 1970, big market downturn. And it turns out a lot of these early funds weren't actually that hedged.
Got caught up in the bull market before that.
Yep. Used heavy leverage, got complacent maybe,
Yeah.
and they lost huge amounts of capital. The source says some lost like 2/3.
Wow, so much for non-market correlated returns.
Right. That promise didn't really hold up under pressure. And by the early 80s, the whole industry had shrunk dramatically. Very few of that first wave were left.
Okay, so the first chapter slams shut with a crash, which brings us to the next generation, the ones who rose from that period. The source introduces Michael Steinhardt. Sounds like a legend, maybe a bit terrifying.
Yeah, the descriptions are vivid. Tough upbringing in Brooklyn, confrontational father who was a gambler. The source suggests that shaped his trading style.
Sounds plausible.
And clearly brilliant. Graduated college super early. By his mid-20s, he apparently thought he was the hottest analyst on Wall Street.
Confident guy.
Extremely. The source paints a picture. Short, barrel-chested, prone to these terrifying outbursts. Face and temples going bright red. People literally shaking afterwards.
Yikes. So his investment style.
Built on contrarian views.
Yeah.
Bidding against the crowd. The source mentions people on his team like Tony Salifo using non-traditional analysis.
Like what?
Long-wave economic theories, conjunctive waves, that kind of thing.
Yeah.
Maybe the theories themselves were debatable.
But they work sometimes.
Well, Salufo supposedly called the 73-74 collapse and the recovery. So that definitely validated their willingness to think differently.
And Steinhardt had another edge, didn't he? Something about block trading.
Yes, a really significant edge, according to the source. Because his fund moved such large blocks of stock, he generated massive commissions for brokers.
And in return,
He could expect special information, often involve, let's say, creative bending of the rules.
like what kind of bending?
Brokers might subtly tip him off if a big seller was about to move stock, or if a sale was just the first part of a larger unloading, getting a heads up.
Right, and the source points out that wasn't exactly great for other investors like mutual funds or pensions. They weren't getting that tip-off.
No, they might get worse prices. It's framed as a kind of reverse Robin Hood, benefiting Steinhardt's wealthy investors.
But there's nuance.
Yeah, the source adds that nuance, argues that in the less efficient markets of the 70s, Steinhardt actually provided a valuable service. He helped institutions move large blocks, provided liquidity, so maybe the benefit outweighed the rule-bending downsides.
Fascinating trade-off. So, while Steinhardt's navigating the stock market, there's this other thing happening in commodities in the 70s. Volatile times.
Hugely volatile. Food prices, exchange rates, all over the place because of global events. And that created a big need for hedging.
For companies dealing with that risk.
Exactly. Food producers, growers,
Yeah.
multinationals. And that created opportunity for traders specializing in commodity futures, like the folks at Commodities Corporation.
Founded by people like Helmut Weimar and Michael Marcus.
Right. Weimar started as an economist, big believer in data and models, but he learned some hard lessons.
Ooh.
The source tells this wild story about a corn trade in '71 that went horribly wrong, nearly bankrupted the firm, immense pressure, strained relationships. There was even a shotgun involved. For rabbits, thankfully. But still, intense. The point, according to the source, was it taught Weimar humility, that relying too much on data could lead to hubris, dangerous positions.
Good lesson to learn early. And Michael Marcus, he sounds like a character too.
Oh, absolutely. The source describes him as incredibly intense, controlled, especially his diet, like purifying himself with raw vegetables to an extreme.
Wow.
But then he'd spend his winnings lavishly. Parties, exotic homes he never slept in, took kickboxing lessons with a champion. A real study in contrast.
And his trading style.
Influenced by his time on the exchange floors, he respected trends, watched the tempo of the floor traders.
The energy, the excitement.
Yeah, if a price broke decisively past the previous day's high, he figured excitement was building, it would keep going, he'd jump in with big positions.
Risky.
But, and this is key, he always used a stop-loss order. If it moved against him by a certain amount, boom, he was out automatically. Limited the damage.
So ride the wave, but have an escape hatch.
Exactly. Either the trend worked and he made a lot, or he got out quickly. That trend following, combined with Weimar's data work, really fit the volatile 70s.
Okay, moving into the 80s. Enter George Soros, a name synonymous with global macro trading.
Yeah, the source paints him as this public intellectual figure, aspiring to the world of ideas, European accent, wide interests, multiple languages.
And his fund, Quantum.
Really embraced global investing, used everything, stocks, bonds, currencies, commodities, long, short, all over the world.
He became incredibly influential, didn't he? People comparing him to Buffett.
Yeah, The Economist called him the world's most intriguing investor. Fortune suggested he might be more significant than Buffett.
But that kind of fame, sometimes it preceded trouble.
The source points that out. Big public adulation often seemed to come before difficult periods, like a big 23% loss in '81, or the turbulence around the '87 crash.
His strategies were complex, but the source details some key trades that show his approach. Let's look at a couple. First, the Plaza Accord, 1985. Major nations agreed to devalue the dollar.
Soros's move here is interesting because, according to the source, he didn't necessarily predict the accord.
Oh, so what did he do?
He massively bought Japanese yen after the announcement, once the trend was obvious.
Ah, so it wasn't about prediction, it was about reaction.
Exactly. Aggressively piling on once a powerful trend was established. Stanley Druckenmiller, who later worked for him, tells the story.
Go on.
Soros was apparently furious because traders were selling yen too early, taking profits. He told them they should be buying more. Druckenmiller took that to heart. When you knew you were right, there was no such thing as betting too much. You piled on as hard as possible.
Wow, that's conviction. Which leads us to the trade that really made his name, the sterling attack in '92.
The big one. A huge macro bet against the British pound.
What was the setup?
Okay, context. UK recession. Germany's Bundesbank refusing to lower interest rates.
That
Put immense pressure on other European countries, like the UK, trying to keep their currencies pegged within the European exchange rate mechanism, the ERM.
Right, the currency bends.
So Druckenmiller does the analysis, sees the vulnerability, the opportunity to challenge the pound's peg.
And Soros, embracing the pile-on philosophy.
Decided they should go nuclear. They started selling massive amounts of sterling.
How did that work mechanically? Who were they selling to?
Anyone willing to buy. But crucially, that included the Bank of England itself. Because under the ERM rules, the bank had to buy sterling to defend its price within the band.
So Soros and others are selling, and the Bank of England is forced to buy.
Exactly. Using up its foreign currency reserves, trying to prop up the pound. As more traders saw what was happening and joined in, the pressure just became unbearable.
And the result?
Within days, the UK government had to pull the pound out of the ERM. Quantum Fund made about $1 billion.
$1 billion, just from that trade.
Yep. The source calls it a vast financial transfer from British taxpayers, whose central bank was forced to buy a currency about to be devalued, to global traders.
Incredible. And they had other big macro wins, too.
Yeah, betting on French bonds, and apparently another $1 billion win shorting the Swedish krona, though they kept that one quieter.
Okay, so while Soros is shaking up global currencies, Julian Robertson is building Tiger management, focused more on picking stocks, right?
Primarily, yes, and incredibly successfully. From 1980 to its peak in '98, Tiger averaged, 31.7% a year? The S&P 500 was around 12.7%.
That kind of outperformance. The source says it felt like an affront to the efficient market hypothesis.
It really did, because his approach seemed, on the surface, straightforward. Not complex models or exploiting tiny glitches.
What was it then?
Aggressive portfolio management. Constantly swapping good companies for what he thought were better ones. Risk limits, like no more than 5% in one stock. Sticking to his guns.
And he was good at short selling.
Very good. Naturally skeptical. His big win shorting Prime Motor Inns, which collapsed, showed how profitable that could be. A lot of traditional funds struggled with shorting. He famously said, "It's me and the patsies."
Ouch. Any anecdotes about his talent?
Several in the source. His command of company details was apparently amazing. He could spot key points others missed. There's that story about the golf game.
Oh, yeah.
Saw a CEO subtly nudge his golf ball, decided not to invest based on that sign of questionable character. Jim Chanos, the famous short seller, managed money for Robertson, Soros, and Steinhardt.
What did he think?
Considered Robertson the most intellectually engaging, the one he'd trust his own money with. Said he knew stocks better than anyone.
High praise. And the culture at Tiger, intense.
Sounds like it. The source mentions that mountain rope test anecdote. Young analysts crossing a ravine on ropes in bad weather. One slips, gets caught by a safety line.
Wow. A test of fearlessness.
Maybe. Presented as reflecting the spirit Robertson embodied and expected.
Okay, speaking of market efficiency, or inefficiency, the 1987 crash seems like a real turning point for those theories.
Absolutely. The source calls it a triple attack on the efficient market idea. Statistical data challenged it, institutional behavior during the crash showed its limits, and sheer panic psychology took over.
Black Monday.
Prime example. Even sophisticated investors who should have bought cheap stocks couldn't. Phone lines jammed, credit dried up, the selling pressure was overwhelming. It was too risky to stand against the tide, even if you knew prices were nuts.
So the theory that a few rational players could fix things didn't hold up in chaos.
Exactly. Institutional failures and panic could just overwhelm them.
And this realization that markets weren't always efficient, that actually helped hedge funds grow, didn't it?
Precisely. If markets can be irrational, there are opportunities for skilled managers. Steinhardt's Info Edge, commodity traders riding volatility. The source notes that this encouraged finance professors to start funds, got endowments like Yale to allocate serious capital. It fueled that post-'87 growth.
Though the source also mentions a flip side, that maybe these fast-trading hedge funds were demons on steroids in irrational markets.
Yeah, that suspicion was growing too.
And that growth, the bigger scale, it brought new challenges by the mid-'90s. Leverage, crowded trades. Steinhardt ran into trouble again in '94.
A massive blow. Lost $1.3 billion, fund down 30%. The source puts it down to a crowded trade.
What was the trade?
European bonds. Too many leverage players piled into the same bet. When the market turned, Everyone rushed for the exit at once, making losses much worse.
Did Steinhardt see it coming?
Looking back, he admitted he was naive about just how crowded that trade had become. Didn't sense the danger.
This whole issue of leverage and crowding, it becomes tragically central to the story of long-term capital management, LTCM.
LTCM, yeah, presented as the absolute peak of highly leveraged quant arbitrage. Their strategy was all about tiny price differences between almost identical things.
Like buying one bond, shorting a near-identical, slightly pricier one.
Exactly. Expecting the prices to converge eventually. They saw it less as investing, more as arbitrage. Almost certain profits, they thought, based on their complex math models. Nobel laureates on the team.
The smartest guys in the room.
Supposedly. Yet they blew up spectacularly, within just a year or two of their peak.
Why? The source says, crowded trades again.
Central to it. Despite their secrecy, an army of imitators had figured out a lot of their strategy. So tons of funds were doing similar trades.
Making LTCM's positions monstrously crowded.
Right.
Yeah.
So by spring '98, if LTCM needed to sell, the source says there was nobody left to buy without tanking the price.
And then Russia defaults in August '98.
That was the trigger. Market turmoil, their arbitrage bets go haywire, and they're forced to sell into totally illiquid markets.
And the irony.
Painful irony, yeah. LTCM made money trading against institutions forced to sell for non-market reasons. But in the end, they became the victim of forced selling.
How so?
Banks got scared, pulled loans. That forced LTCM to liquidate assets at fire sale prices. The source even suggests other traders, knowing what LTCM held, deliberately shorted those assets to profit from their forced selling.
Brutal. There are anecdotes.
A partner getting the news on the golf course.
Yeah, Larry Hillenbrand. And John Merriweather calling John Corzine at Goldman Sachs trying to arrange a rescue didn't work initially. What was Julian Robertson's take on the LTCM collapse? Did he see it as relevant to Tiger?
Not really. He argued LTCM failed because of recklessness, inexperience managing that kind of massive capital under stress, and a flawed strategy trying to harvest tiny returns with insane leverage.
He contrasted that with Tiger's approach.
Yep, seeking bigger payoffs with less dangerous leverage. He wrote to Tiger investors saying basically nothing about their strategy or leverage would change despite the market turmoil.
Okay, moving towards the late 90s, the tech bubble. That must have put pressure on value guys like Robertson.
Huge pressure, even if they were skeptical, like Robertson clearly was. The source has his famous quote about feeling like he was eating grass while everyone else feasted on tech stocks he didn't understand.
Quantum felt it too, Druckenmiller.
Yeah, the source describes immense pressure to join the party, even against better judgment. Druckenmiller felt conflicted. He shorted tech, then bought it back. Partly influenced by younger guys making fortunes, partly fear of looking wrong.
Robertson faced losses too. Convene a crisis council.
He did. And there's that telling anecdote from a Tiger crisis meeting about the Japanese yen surging against their short position.
What happened?
Michael Bills, one of his team, argued the market saw Tiger as weak. His suggestion, counterintuitive, attack rather than retreat. Add to the short yen position.
Double down. Why?
To show conviction, fearlessness, maybe even push the market back. It really shows the high-stakes game playing out under that bubble pressure.
Meanwhile, a quieter revolution was happening. Quantitative trading. Jim Simons at Renaissance Technologies, David E. Shaw.
Right, a totally different approach. Simons, the mathematician, ex-codebreaker, starts hiring these brilliant math minds, ACACs,
What was their goal?
to build a machine, an automated system to trade based purely on computer signals, pattern recognition, and data. Move away from intuition or fundamentals.
As one guy put it, attempts to look at fundamentals did not get us very far.
Exactly. David Shaw was on a similar path, building systems to find statistical anomalies. Jeffrey Bezos was an early employee there, interestingly.
Any differences in their approach?
The source notes, Simons often hired established scientists, set up shop away from Wall Street on Long Island. Shaw maybe favored younger quants initially.
And money was flowing into these quant funds.
Increasingly, yes. Simons launched the Renaissance Institutional Equities Fund, RIEF, in 2005, specifically to handle huge sums. Targeted $100 billion, raised over $25 billion pretty quickly.
And it wasn't just quants attracting big money. Institutions were getting serious about hedge funds generally, weren't they?
Oh, absolutely. A major shift, moving beyond just wealthy individuals. David Swenson at Yale's endowment was key here.
The Yale model?
Right. Started investing in Tom Steyer's Farallon Capital back in 1990. Yale dramatically increased allocations to hedge funds and also real assets like private equity, and lots of other endowments followed suit.
What was the appeal?
Diversification, mainly. Getting returns that weren't tied directly to the stock market. Accessing alpha, that pure manager skill.
And Farallon, Steyer's fund, what was their strategy?
Mostly event-driven. Betting on specific corporate events like mergers, bankruptcies, things that have somewhat predictable outcomes, separate from the overall market direction. They also got into frontier markets early.
The source has that story about Indonesia, right, after Suharto fell.
Compelling anecdote. Farallon bought this bank, BCA. The Indonesian government, under IMF pressure, was a non-economic seller, had to sell assets fast, cheap. Farallon saw an opportunity.
Bought distressed assets with little competition.
Yeah. And the source frames it as potentially doing well by doing good. They brought in new management, restructured the bank. Apparently, thousands of workers got rehired.
But it wasn't all smooth sailing for Steyer. The source mentions challenges, too.
Balances the story.
Yeah.
Steyer had this really frustrating experience with a Colorado water project. Spent years, over $20 million. Hit local resistance over user fees, failed at the ballot box, got sued by the local partner. And, reflecting growing scrutiny, students at Yale protested the endowment's investment in Farallon.
Okay, so that brings us hurtling towards the 2007-2008 financial crisis, a period where hedge funds were right in the thick of it. John Paulson's famous bet.
The big one. His massive, incredibly profitable bet against the subprime mortgage market.
What was the backdrop?
Housing market slowing down, mortgage costs rising. Paulson's analysis was, well, brilliant in its clarity. He saw the potential upside from betting against these dodgy mortgage bonds was way bigger than the potential downside.
Like roulette, but with better odds.
That's how the source puts it. He calculated huge potential gains, like 900%, even if default rates were incredibly high, say 80%. The reward massively outweighed the risk premium he had to pay.
And he went big.
Incredibly aggressive execution, bought vast amounts of insurance against defaults, credit default swaps, CDS. The source quotes him calling it the Holy Grail. Channeling Soros, go for the jugular, bought billions in just 2 days, apparently.
And this contrasts sharply with what was happening inside the big investment banks.
Very sharply, as highlighted in the source. Banks like Merrill Lynch were distracted. They had all these different profit centers, trading, underwriting, advisory.
The scramble for fees, especially from packaging and selling those subprime mortgage products, CDOs.
Exactly. That fee machine was hugely profitable. But to keep it running, they ended up holding billions in unsold mortgage inventory themselves.
So when the market turned, they weren't just middlemen anymore.
They were massive investors in the toxic stuff, almost accidentally. The source argues that when chasing commissions distorts investment choices, it's hardly surprising that the investment choices are horrendous.
And what about Bear Stearns? Their internal hedge funds blew up.
Right, and the source argues Bear felt obligated to rescue them, which kind of validates the idea that having a deep-pocketed parent can dull the incentive for careful risk-taking. There's that implicit safety net.
Meanwhile, Paulson's bet against it all nets, what, $15 billion? Biggest hedge fund payoff ever.
Something like that. Paulson himself pocketed billions.
Before the main crisis hit, though, there was that weird quant quake in summer 2007.
Yeah, that was puzzling. Lots of quant funds, relying on their models, suddenly took big simultaneous losses. Stuff their models said shouldn't happen, or was incredibly unlikely.
Cliff Asness at AQR saw it on his BlackBerry in a subway.
That's the anecdote. Huge losses hitting multiple funds at once. The causes, still debated. Maybe a hidden risk factor everyone's model shared. Maybe forced selling by one fund triggered a cascade.
Asness argued it wasn't just crowding.
He pushed back on that, yeah. Framed it more as good investing gets clocked when panic causes investors to rush for the exits all at once. Ultimately, one quant exec called it not a big public policy issue, but definitely unsettling for them.
But the main 2008 crisis was a huge public policy issue.
Massive. Short sellers like Jim Chanos, who bet against financials, did well initially, but then the government stepped in.
The ban on short-selling financial stocks.
Yeah, this source calls that a frontal government assault on hedge funds' viability. Hurt funds badly. One trader said they went from playing chess to rugby at halftime.
And investment banks like Morgan Stanley, Goldman Sachs, they sought Fed protection after avoiding stricter regulation before?
They did. Ran for cover under the Fed's umbrella.
Interestingly, the source presents Citadel's experience in 2008 differently, as maybe a model of how the financial sector should work, even though they lost massively.
Yeah, it's a provocative point. Citadel, Ken Griffin's firm, took a huge hit. Down 55%, lost $9 billion. But crucially, they survived without a government bailout.
Why?
The source credits careful liquidity management. and less reliance on those shaky short-term loans that brought down banks like Lehman. Citadel was built on a more stable funding base, comparatively.
So while lots of funds lost money or failed,
The industry overall did better than the stock market, the source notes, and importantly, imposed no costs on taxpayers, unlike the big bank bailouts.
the source also mentions a couple of other crisis-related blowups. Amaranth in '06.
Right, natural gas trading. Aggressive trader, crowded trade, couldn't get out of huge positions when the market turned. Citadel actually bought their positions in the end.
And Tiger had money trapped in Lehman when it went down.
Yeah, Robertson's fund got caught there too.
Yeah.
Shows how interconnected things were.
So looking back at this whole history, drawing from the source, several themes keep coming up, don't they?
Definitely. You see this evolution from, individual genius and intuition towards more systematic, quantitative, almost factory-like approaches.
And that constant tension, innovation and skill versus these hidden risks, leverage, liquidity freezes, crowded trades.
Always lurking. And the whole debate just keeps circling back. Are markets efficient or are they flawed, prone to panic and error?
And ultimately, the source really hammers home a difference in incentives, doesn't it, between hedge funds and big banks.
A fundamental difference. Hedge funds, especially early on, often had managers' own money at risk, high water marks, structures designed to incentivize careful risk management.
Contrasted with banks risking depositors' money, bondholders' money, distracted by fees, maybe expecting a bailout, moral hazard.
Exactly, that's the argument. The source's conclusion is pretty stark. Hedge funds, despite the volatility, might actually be less risky for society overall than the big regulated banks.
Because they're safe to fail, their collapse doesn't usually require a taxpayer rescue.
Right. Capitalism, the argument goes, works best when institutions bear the consequences of their own risks. Banks deemed too big to fail, expecting bailouts. Well, the incentive to avoid excessive risk gets weakened.
So we've taken this deep dive through a really fascinating history. A.W. Jones's clever idea, the macro legends, the quants, the crisis players, all drawn from the source material you provided. Incredible personalities, strategies, booms, and busts.
Yeah, we've explored leverage, hedging, market efficiency, the impact of personalities versus systems, and those crucial differences in incentives. Lots to unpack.
And here's a final thought for you to consider, building on what we've learned from these sources. If capitalism works best when institutions absorb the consequences of their risks, and the source argues hedge funds are often better at this than the huge banks that expect government support. What does the continued structure of our financial system, relying so heavily on those large institutions deemed too big to fail, what does that really tell us about who ultimately bears the risk when the next crisis inevitably arrives?
Something to chew on. We definitely encourage you to keep exploring these ideas, maybe dig deeper into the figures or moments from this deep dive that particularly caught your interest.